Welcome back to All Things Money. I'm David Blain, and for this segment we're going to be talking about investor sentiment and how it affects the markets. We've talked on previous shows about investing is driven a lot by fundamentals and the value of companies and things like that, but increasingly over the years a lot of the market has been driven more by psychology than anything connected to reality, frankly, sometimes. And so tonight we're going to take a look at a little bit, what do we mean by sentiment? How does it affect the markets? And we're going to take a look at some of the ways that you can use this to benefit your portfolio. One of the things that over recent years has been doing a lot of research is on the psychology of investors, whether they're very optimistic or very pessimistic. It's very difficult to measure this. It's not like earnings where you can look at a company and see how much money is in the bank or look at a price to see if it's gone up. Sentiment, there's no real good way to measure it other than simply asking people. And so there are several polls out there that on a regular weekly or monthly basis ask people, are you overly optimistic? Are you pessimistic? How do you feel about the market? And so it's through these polls that we can begin to build a sense of what's going on in the market. Today we'll take a look at two similar yet slightly different polls. The first one is from Ned Davis Research, where he looks at investor sentiment of professional investors measured against the Standard & Poor's 500 index. The other, by Investors Intelligence, gathers similar data to the other poll, but it uses, but we've transposed this data into actual buy and sell signals for the market. So according to the research conducted by Ned Davis, since January of '95, the prevailing sentiment among investors has never actually predicted the direction of the market. And what do we mean by that? I mean that whenever investors become overly optimistic in the market usually goes down. When investors are overly pessimistic, the market usually goes up. And so this research company called Ned Davis, they poll various institutional investors every week. And when more than 66% of the professional investors out there are optimistic about the direction of the market, the average gain is minus 15.7%. So once again, when the majority of professionals are optimistic about the direction of the market, the gain in the market is actually negative. And this happens about 16% of the time. In contrast, when less than 57% of the professionals out there are optimistic about the direction of the market, meaning that they're actually pessimistic about the direction of the market, the gain is about 9.8% per year. And what we see is that the sentiment of the market goes in sort of waves, that people become overly optimistic, then it declines into pessimism, and then they start to begin to be optimistic again. And what we found is that when people have gone from overly pessimistic and their optimism starts rising is the best time from a sentiment perspective to be in the market. We see since 1975 that this has returned an average of 14.4% per annum. And I know you can't see this on TV or actually on the radio if you're listening on the radio, but I'm looking here at a graphic of every time the market either reached an extreme in pessimism or an extreme in optimism since 1995. And it's a list of probably 40 or 50 times where these extremes were met. Well, every single time the majority of the crowd was wrong. And this is just a powerful statistic when you understand it. It kind of goes back to Warren Buffett, and he says that when others are fearful, you should be greedy, and when others are greedy, you should be fearful. And this is borne out by this evidence that when professionals become overly optimistic is a time that you should consider lightening up on your positions, whereas when people are overly pessimistic is a good time to buy. We see this also, there are other polls, the American Association of Individual Investors, which is an organization that looks at the attitudes of individuals. When the portion of their portfolio is allocated to stocks, reaches highs, usually signals the peak of a market. And at the same time, when they're allocating less and less money to stocks, it usually signals a low in the market. The other data collected by Investors Intelligence, it was similar to the Ned Davis poll. We use it to determine actual buy and sell signals. And this one uses the Dow Jones as the benchmark instead of the S&P 500. And what they have found is very similar to the Ned Davis, is that as the sentiment indicators reach an extreme, we find the opposite. For their poll, when the optimism reaches above 69% optimistic, the average gain is slightly negative. When their optimistic poll drops below 53%, meaning just about half and half are optimistic and pessimistic, the gain per year jumps to almost 12%. So once again, these findings are consistent with the Ned Davis poll. The Investors Intelligence poll reaches the same conclusion, that when the majority of the population and professional investors are overly pessimistic, the market tends to rise significantly. When the majority of people are overly optimistic, the market tends to fall. And we saw this happen in recent memory at the peak in 2000 of the tech bubble, as well as the latest peak in October of 2008. Most people were very optimistic about the direction of the markets, and hence we saw the collapse. In March of 2009, we saw a major low in optimism, and hence the markets were able to rise. So that brings us to our next break. If you have any questions, feel free to give us a call at 633-0107. For All Things Money, this is David Blain.